one of the things that someone told me earlier on in my career and really stuck with me, and I think kind of actually helped guide some of the shifts in my career, but make sure you're doing something that you really love and you're passionate about. You spend the majority of your time working. You should be doing something you love, and when you do that, you'll be more energetic, more passionate, and you'll be exceptional at it.
Welcome to Deal Flow with me, Michael Poulio, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Welcome to Deal Flow with me, Michael Poulio, the go-to destination for high-level private equity and real estate professionals, including institutional investors and market experts. I talk with industry professionals week on everything real estate. Julian joins us. Julian Schonfeldt is the Chief Investment Officer at CAPREIT, Canadian's largest apartment-focused real estate investment trust. With a background in investment banking at RBC and a solid foundation as a CPA and CFA, Julian brings a wealth of expertise in deal structuring, strategic dispositions, and portfolio management. Under his leadership, CAPREIT has executed over $3 billion in transactions this year, focusing its strategy on selling older, non-core assets and reinvesting in higher quality, newer construction deals. Julian, thank you for joining us today.
Thanks for having me on, Michael.
Yeah, it's a pleasure. I'm excited about having this conversation with you. So, I know I gave you a little bit of an intro, but if you wouldn't mind, just kind of give people a rundown of your career up until what you're focused on today.
Yeah, perfect. Thanks. Firstly, I'm the proud father of two beautiful, smart little girls that are very supportive of me. Secondly, as you mentioned, I'm the Chief Investment Officer at CAPREIT. I started out working in accounting. I was at PricewaterhouseCoopers and KPMG. Figured that wasn't really for me, but that's where I got the CPA that you mentioned. After which I moved into investment banking. I ended up landing at RBC Capital Markets. I worked in the real estate investment banking group. Spent about a dozen years there and really got to work there at a very exciting time when interest rates were dropping and there was a ton of capital markets activity. So worked on a flurry of IPOs, equity offerings, debt offerings, M&A, strategic advisory, and really got a lot of experience there and got to work with a lot of Canada's large REITs. One of which was CAPREIT. RBC was a sole book runner for CAPREIT, so I got to raise a lot of equity and advise them on many transactions, and I got fairly close with the management team. About 2.5 years ago, the CEO and CFO engaged in a conversation with me about coming in-house, and it was a very exciting opportunity, and CAPREIT was undergoing a very important strategic pivot, which you alluded to in the intro. So I was very excited to join, and it's been about 2.5 years doing that. I oversee the investments group, so acquisitions, dispositions, the development group, strategic finance, investor relations, and legal.
Awesome. Well, thank you, Julian. That was great. So I think I love to, before we get into a little bit about the pivot and kind of your current role, what encouraged you or what made you decide that you wanted to move from the world of accounting? It's like a silly question maybe because it's maybe more interesting, but moving from accounting to investment banking and then ultimately moving, from the sell side to, I guess, the buy side, kind of that progression. Was that all kind of thought through in advance, or was it kind of just, not fallen into because you obviously worked very hard to get to this point, but kind of tell us a little bit about the mindset of moving from, the start of your career to today.
Yeah, when I was in school, I saw a lot of value in the CPA designation, and I still do. I think it's a great base to have. Any type of analysis that you're doing, and I knew I wanted to get into investment banking, but I thought it would be a great kind of stepping stone working in accounting. What I didn't like about it was that it's kind of, you're looking in the rear view mirror and telling a story of what happened when you're doing the accounting. And, for myself, I thought it'd be a little bit more exciting to be kind of more forward looking. And so that's what made me switch over into the investment banking side and actually working on live transactions, and really the exposure you get with the investment banking on working on very large transformational transactions and getting to work directly with CEOs, CFOs, and management teams on some pretty exciting deals was what appealed to me. And I got very fortunate to be able to work at RBC, Canada's largest investment banking shop. and at a particularly exciting time where honestly there was just transactions left, right, and center. So got all sorts of exposure. Ultimately, and I worked with a great team, and RBC was an amazing shop, but ultimately I'd done it for a dozen years. I'd gotten a lot of exposure, and I wanted to try something different. I mean, one of the kind of benefits, but also something I wanted to shift from, was the fact that I got to work with a bunch of different REITs and companies, and got to touch on their companies for a few months at a time while you're working on a transaction. And you're always switching kind of coverage, but I wanted to really work with one company, dive deep, and rather than advising on transactions, being actually executing on them and being accountable for them, for better or for worse. And so that's kind of what drove it. That, and the fact that I got fairly close with the CAPREIT team, and they're all excellent. It's a really excellent management team there, and it was very exciting to be able to work with a bunch of colleagues who I frankly considered friends. So that's what drove it.
That's great. Before we move into CAPREIT, could any notable deals at RBC that come top of mind that you could talk about that interesting deal stories?
I'll lean on the CAPREIT ones. CAPREIT, and it'll kind of flow well into this transaction. But CAPREIT was a very, very active REIT. It was one that was it was IPO'd in 1997, so close to 3 decades ago, and it's the largest REIT in the country. And it got that way by being incredibly active on the acquisition side and on the capital raising side. And so throughout, we got to raise billions of dollars of equity with CAPREIT and advise on many transactions, some which went through and some which didn't. And got to touch a whole bunch of large acquisitions. I mean, one year we raised over $1 billion of equity for CAPREIT. Actually, not that long ago. I think it was about 6 years ago. And there was a reverse takeover of another publicly listed company, which sprawled the creation of our European residential REIT, which is 65% owned by CAPREIT and has had a pretty interesting history. So with CAPREIT, I got to get a lot of exposure to all sorts of different types of files, which was quite interesting.
Okay, very cool, very cool. So let's move into CAPREIT now. So give us a little bit. I know the 30-year public history, right? So probably that investment strategy's changed a bit since the late 90s. But tell us a little bit about CAPREIT today, kind of what you guys are focused on, and what does the book look like today, and for our listeners.
Yeah. So, as I mentioned, the history of CAPREIT was acquire, raise equity, and kind of rinse and repeat and keep going. It was a great strategy at the time while interest rates were declining, and any assets that you got your hands on pretty much shot up in value. We find ourselves now being the largest REIT by public float in the country. The strategy for us has been, that we've grown such that we have scale, which has a huge benefit to us. But trying to, rather than grow, work with what we have and improve it and improve the focus and the quality. And so there were a lot of assets that were purchased in portfolio acquisitions that are lower quality, don't really fit in well with the portfolio. CAPREIT had amassed the second largest manufactured housing communities portfolio in Canada, and also formed or IPO'd the largest residential housing provider in Ireland, and then built a very large portfolio in Netherlands. And so, if that doesn't make your head spin a little bit, it helps inform what we're trying to do is really just kind of now focus into a more simple, higher quality story. And so how that has evolved is we've now sold our manufactured housing community portfolio. That was just done at the end of 2024 for $740 million. Earlier in the year, we sold our interest in the Irish REIT called IRES REIT that we had IPO'd in 2014. So we exited the MHC, exited the Irish REITs. We also have sold about half of the European residential REIT portfolio, which was the Netherlands properties that CAPREIT had seeded in through that reverse takeover. And we've been selling a lot of our what we would deem non-core, older, lower quality apartment properties. And so the mission is to just turn the company from being really kind of large, diversified, and frankly, sometimes tough to understand investment vehicle into one that's laser focused into high quality apartments across Canada's major markets. And really leveraging the skill set that we're best at, which is Canadian apartments. I say this um, with a bit of bias, but I do truly believe we have the absolute best operating team for Canadian apartments that exists, and I think we've got the best investments team. The scale that we have and the experience that we have allows us to be exceptional at Canadian apartments, and I think it's the best use of our efforts and the best outcome for our investors if we're doing what we're best at, and that's Canadian apartments. So we're really trying to move that to a laser focused strategy and work with what we have and make it better quality. The old strategy of getting bigger was great at the time, but right now we already are the largest by float, so we don't need that extra size. So the focus for us now is really just improving what we have.
Mm-hmm. Yeah, so it sounds like getting rid of a lot of the non-core assets, lower quality, non-Canadian, going back to the roots of Canadian apartment REIT, and having less of this like non-core exposure. And it sounds like you've made a lot of headway on this strategy at this point. It seems like a lot of those non-core assets you've divested largely. Are there other assets that you can speak to that you're still looking to that are on the chopping block, or at this point, kind of what does the go forward look like? So far as things that you want to still sell, get out of the portfolio, as well as looking for new opportunities within Canada in the apartment space.
Yeah, you're absolutely right. I mean, we've traded over $3 billion worth of transactions in 2024, and Canada has been I'd say, relatively illiquid market over the last couple of years. And so to be able to do that, I think was an incredible feat by the company and by the teams. And we're very proud of that. I think that would probably place us as the most active real estate investor in Canada. But there's still more wood to chop. I mean, it's a $15 billion balance sheet that was accumulated over 3 decades, and we have a very active and capital allocation process. And there's, quite frankly, from the non-core apartment side, there's still a few $1 billion worth to continue to chug through. So it's going to be a multi-year process, and particularly in light of how illiquid the market's been. It will take time. We've been very disciplined with selling our properties above our book values, and with the limited buyer pool that exists, it does take time. But we're going to continue to work through it. Also, there still remains a substantial portion of the portfolio that's in the Netherlands through European Residential REIT that we're continuing to work through. But we're excited we're very happy with the progress we've made over the last couple of years, and we're very excited to see where the company will be in the next few years.
Mm-hmm. So, 3 billion on 15, that's a pretty good percentage of the portfolio to churn over, what, just for listeners, for those, the public REIT space is a little bit of a different animal versus a lot of, other types of shops that might have like a fund model or a deal by deal model. When you're dealing with a public REIT, and you sell assets, what happens with the liquidity? Does that go back to the investors? Are you able to redeploy that capital? Tell us a little bit about how that, that happens, for people.
Yeah, sure. It's a fairly dynamic process. I mean, the scale that we have gives us a few different levers we can pull. I'll say broadly, we look at it into 3 buckets generally. When we sell something, we can either buy on strategy properties, and for us that means newer construction, high quality properties in major markets that we view favorably. The second bucket we can look at is debt repayment. CAPREIT doesn't have a leverage problem. It's conservatively levered, but at the same time, we're fine to reinforce our already strong balance sheet, and which can provide future liquidity or optionality. And the other one is our share buyback program. since the spike in rates back in 2022, the REIT market's traded down, unsurprisingly, and our shares for much of the time were trading below NAV along with everyone else's. But we view that as a really attractive way to deploy capital, in that we can sell what we would call or characterize our worst assets above our book value, and then buy back the enhanced portfolios. And I say enhanced because we've been selling out the worst of it, and we can buy that back at greater than 20% discounts, right? And so and that's part of the benefit of being a public entity. A lot of the funds that, if they're doing redemptions or buying out partners, it's at fair market value. But we've got this tool where we can buy back our shares and essentially buy back some investors at a significant discount. And so we view that as a very strong ARB. Last year in 2024 alone, we did over $300 million worth of buying back our shares, and that would have been north of a 5% cap rate, whereas that would have been funded by selling our worst assets, in a low 4 cap rate area. So between those three buckets, that's what we look to do, and it changes, right? And so I'd say in September of last year, our shares had moved up quite rapidly when rates were moving down, and they started trading above NAV, and so that share buyback option was off the table. And frankly, if it had moved enough, it could have actually turned into the opposite, where it became a source of capital rather than a use of capital. And so at that time, we were really just looking at doing new acquisitions and maybe a little bit of debt repayment. So it's dynamic, and we're always kind of reevaluating things as we close dispositions and capital comes in.
Yeah, no, that's I'm jealous. It's a little bit harder when we're in the illiquid space, and there's just not a lot of there's not a lot of optionality so far as getting liquidity. But that's a great option when you're a public REIT and you have that ability to kind of do a couple different things depending on what valuations look like in the market versus your own stock. So that's great. You talked a little bit about buyer pool. You're dealing with very large transactions. You're dealing with assets all over the world in various markets. How do you go about identifying on the disposition side? And then we'll talk about the buy side. But what I assume you work with brokers to handle these transactions. But tell us a little bit about how and what types of what's the buyer avatar for the assets that you're selling typically, given the size and given the unique nature of the collateral?
Yeah. So there's, we've done kind of two different types. I'll say some of a lot of the apartment sales that we've done have been of smaller size, and those have been going to private institutions. I'll say the institutional interest for the private assets has been a little bit drier since the interest rates went up and capital availability has gone down. So we haven't seen the institutions be that active buying the lower quality properties. It's mostly been private players, syndicators, a lot of folks that we would not have dealt with in the typical course. Some of them are very great and easy to work with. I'll say some of them are a little bit less sophisticated, less focused on reputational issues, and so it's been a little bit more of a grind. The deals will take a lot longer. There's a much higher execution risk, so you really can't rely on them, I'll say, until the deal's gone firm and they've waived on their conditions. And frankly, even then, we've had a few of those where they've left their deposits behind. Mm-hmm. So it takes a lot of grinding through it. The good part for us is that the portfolio is so large, and like I said, there's a lot of wood to chop on the dispositions. So we'll cast a wide net, and we'll know that 3/4 of them will fail, but we still end up because we've cast a wide enough net, and we have properties that we would like to dispose of in many of the markets. Whatever whittles through will get us to our strategic goals. Mm-hmm. On the large, and the other point I'll make is because they're private players, they don't have access to the same capital or cost of capital that the institutions do. I'd say generally, the larger you go with those types of properties, the less of a buyer pool that you have. So there really isn't a portfolio premium. I'd say at this time there's actually a bit of a portfolio discount. So you try and keep it as small as you can. and you try and break up the portfolios as much as you can, and you'll get actually more competitive tension, better pricing, and kind of less single deal risk.
Yeah.
Um,
What is the break points? Given you work in a pretty large market, or a large size. So what is, when you're saying small and large, that might be relatively all very large to maybe some people listening. So is
yeah, fair
100
point.
million, 500 million, a billion? Like where are the break points between a deal where you're going to see a portfolio discount, right? Because it's so
Yeah.
unwieldy and large in today's market.
No, that's a great question. I would say north of 100 million, and you're going to struggle.
Mhm.
You'll like it'll be a couple of potential buyers if you're lucky, and you'll know who they are, and they'll know who they are, and they'll know there's no competitive tension, and it becomes
Mhm.
pretty tough.
Yeah.
Ideal transaction size will be less than 50 million.
Mhm.
Now the good news is there's quite a few of those in our portfolio, and those would be the ones that we would generally characterize as non-core. Although there are some larger ones too that we're kind of holding off on for a different market to transact on. But generally, under 50 million, and you can still get pretty good liquidity and competitive tension there.
Yeah. Yeah.
So
Yeah. Mhm.
now I say that, but we did execute on two very large transactions. So one was the MHC portfolio for $740 million, and then there was one in the Netherlands, $1.1 billion. I would say those ones were unique in that they did have a portfolio premium. The MHC space is very attractive.
Yeah.
Notwithstanding the lower availability of capital, institutional investors are interested. We ran a process on that. It was there was quite a bit of competitive tension, and that one had a portfolio premium. And the reason that one had the portfolio premium is MHC in Canada is hard to acquire. It's hard to scale up on. There's only a handful of portfolios that are large enough for an institution to own. And so, for anyone that has a thesis of Canada and MHC, this was frankly really the only time that anyone could get in at a scale that made sense for large institutions. And so, we framed it as kind of a once in a lifetime opportunity through the marketing process, and it was well received. And I'd say with the Netherlands one as well, there's a very interesting strategy for the portfolio that we sold. That really isn't one that's suitable for public REITs, but works well for private equity. And so we were able to get what we viewed as a portfolio premium or attractive pricing over there as well.
Yeah.
But those ones are a little bit niche and more the exception.
Yeah. Yeah. No, we're definitely seeing, at least in the U.S. markets as well, there's a bit of a disconnect. Anything over 50 million, there's a bit of a kind of a gap in buyers. And certainly, if you go over 75 or 100 million, there's a lot less folks out there that want to participate. And what we were seeing, especially in the post pivot time, like really limited capital for those deals, where those players were all sort of like on the sidelines, waiting for everyone else to
Mhm.
say, "Hey, are we going to jump back in?" Kind of like a hop, like a double dutch. And it doesn't seem like anyone has jumped back. We're not a lot of people have jumped back in those deal sizes, but there does seem to be decent liquidity in the kind of the 20 to $50 million space. Let's move to the buy side for a second. You talk about you're looking for newer assets that are core. Could you talk a little bit about that buy box? What is new to you? What is that? Is there a cutoff on year? Is there a location? Is it based on demographics? Is it based on number of units? Like how do you think about that buy box, that initial filtering, that you do before your team starts to really dig into potential acquisitions?
Right. So I'll say it's not too rigid, but and maybe I'll speak to some of the benefits of it that'll help categorize what we look at. But for the new construction properties, the capex is significantly less than what we would spend on capital expenditures for the value add properties. The cap rates tend to be in and around the same area, so you get the same NOI yield, but with a lower capex profile here, which we view as a pretty attractive dynamic. And depending on the province you're in, some of the newer construction properties are not subject to rent control, so it gives you a little bit of freedom with the rent growth profile. There's a bunch of other benefits, like they're more energy efficient, and maybe it'll be a little bit more operationally smooth or easy for the team, especially as a public vehicle. But that's kind of it. And so when we look at new construction, I'll say, again, depends on the situation, but generally 2010 and newer kind of helps, fit those benefits that I described.
Mhm.
And in terms of size, we tend to like properties that have 100 suites or more to be able to get kind of the economies of scales and the operating efficiency. But that said, our portfolio is so large and we're in all the major markets that we can transact on properties that are 60 doors, and even we just did one that was around 40 doors, because if they're adjacent to our existing properties, we can kind of run them without having to introduce any new staff and leverage our synergies. So that's kind of the frame that we look at it.
Yeah. So, and just so you know, I'm taking notes on what you're saying as we're going. I'm not doing emails over here, but I just like to keep the track going, so I know as you're talking, that I know what to ask you next, because I have a bunch of stuff. So, for the newer deals, you look at 2010s or newer. One thing that we're seeing, at least in the U.S., is a lot of folks that took out bridge debt to do construction during the COVID era, and they're stuck with a property where they're selling at basis, or maybe even a little bit worse than that. Are you seeing that in Canada as well? And you're seeing opportunities where you're able to get really brand new construction that is maybe struggling in lease up, or something 2021, 2022 vintage? Are you guys playing there at all, or mostly off the run 2010 stuff? Like, what's available
No,
these days?
yeah, I'd say we've been doing a lot of stuff that in and around the 2020 range. A lot of what we're buying is from the original developers. It's not often stuff that traded and then is trading again so quickly.
Mm-hmm.
A lot of the developers, as you mentioned, will use bridge loans, construction loans, all sorts of different debt types, and with the lack of the lower availability of capital, and particularly for the larger sizes, we're finding we're not having that much competition, and we are seeing that there are many developers that are under significant pressure right now. Again, under the weight of the debt burden, and a lot of them began these projects when rates were incredibly low, and rates moved up quite a bit on them at the same time that capital, or the availability of capital, dried up. And so we're seeing developers that are under pressure, and we're actually able to get access to properties that we in a normal market probably never really would be able to, or be able to afford. And I look at some of the properties that we closed on last year in 2024, and these are the types of things that these folks would never sell unless they were forced to, and even if they did, you'd be in unreal bidding wars, paying cap rates that just really don't make sense, frankly. So we're in a really fortunate spot that where capital's not plentiful, we've managed to shore up quite a bit through some of the strategic dispositions that we just discussed, and capitalize on this. And I think when we fast forward 5 years from now, we're going to look very proudly at how we took advantage of this market dislocation, and really fortified our portfolio.
Yeah, I remember talking with developers who are trying to build to a 5 something cap rate, and that made a lot of sense when rates were well. I don't know if it made a lot of sense, but they made sense of it when SOFR was at a quarter point or whatever, and it was a lot harder to make sense of that now. And yet, it's when the market cap rate is now around there, or a little bit higher in some cases. So that makes a lot of sense. I guess for folks that don't know the Canadian market very well, me being one of those people, could you maybe speak to any high level differences that you're in the apartment space between the U.S. and Canada? Wherever you want to go here, if it's the type of product, if it's the valuation, if it's how deals move, how you talked a little bit about rent control, wherever you think makes sense to talk about. Just love to see what is the delta between these two markets that people should be aware of.
Yeah, so Canada's a very interesting market. We've gone through exceptional population growth. I mean, I think really leading the developed world, which created a pretty tight housing market, and so vacancy dropped really low, rents pushed up very high, and that helped. That helped in a big way offset the interest rates moving up. So it kind of kept cap rates at at a lower level than they otherwise would have been, because the hit from interest rates moving up kind of was offset by the growth that you would underwrite moving up at the same time. It's a very small market, so the way you operate and your reputation really matter a lot. I find the U.S. is obviously a much larger market, and but here kind of feels like everyone knows everyone, so it's important to have good relationships and do what you say and be reputable in the way you operate and transact. We have something called CMHC, Canada Mortgage Housing Corp, that they provide insurance on debt on apartments. And so that provides us with a really interesting cost of debt. The spreads on 10-year debt are, 80, 90 basis points. And just given the insurance from CMHC, which is effectively a government institution, that capital is always available, or so far it's always been available, and the spreads don't really move that much. So that's been a good equalizer in the debt cost of capital across the playing field. I'd say there's rent control, but it's actually acted in a way as a stabilizer. So when the markets move up, it slows how your rent moves up. But when the rental markets move down, the rent controls cause us all to be well below market rent. So it's been actually a bit of a benefit in a time like now, where there's been a little bit of a slowdown in the market rent growth, but it's been a good, stable, healthy market that's experienced a lot of strength in the fundamentals, and it's treated us well. Yeah.
And the Canadian 10-year is like 100 basis points or more inside the U.S. 10-year. That's not about right? So it depends.
Yeah, it's about three. It's around 3%. Our overnight rate's about 3.25%, so also over 100 basis points lower than yours. That's been due to slower economic growth and slower anticipated future economic growth, which has resulted in inflation that's now below 2% and forecasted to be there. So we're having a little bit of a divergence in interest rates, which has actually also caused our currency to move down, as you would expect. But the lower interest rates is for us real estate folks is certainly very welcome. So we're able to get debt in the mid to high threes right now. Which, having a coupon like that is certainly very helpful for valuations.
And so generally speaking, you also are seeing cap rates, all things being equal, being lower in the Canadian market than in the U.S. given.
Exactly. And one of the benefits of that too is that private buyers will have access to that debt, and you can get actually fairly high leverage using the CMHC insured mortgages. You can actually go as high as into the 90s on LTV. And so private buyers can do that too. And so while we're, I was talking about selling our lower quality properties to private buyers, with them having access to almost pretty much the same, or effectively the same cost and availability of debt as we do. In fact, they use quite a bit higher leverage than we do. It really does help support the valuations and the liquidity, notwithstanding the fairly illiquid market that we're in.
Yeah, that's it. Well, if 90% of your capital is coming from, a pretty much guaranteed liquidity source at those rates, it does support you guys as being able to dispose of those assets at great valuations, especially versus your book values. So that's great. Could you speak a little bit about maybe the capital raising processes for public REITs? Which I assume are different than the deal by deal syndicator model or the fund model, and maybe not. So could you maybe speak to that? Other than selling and then recycling capital, if you're going out to raise new capital, what does that process look like for a public REIT?
Yeah, so right now that's completely off the table for us. Just given we're trading, below 20% or greater than 20% discount to NAV, we would never do that at this time. But for when our shares are above our NAV and we are looking to fund acquisitions or repay debt or whatever the priority is, the typical way would be to do a bought deal. So what you would do is you'd call up your banks, your book runner banks, and you work with them to structure a deal. Usually they're in the, call it, 100 to $300 million size range. Although I say that in CAPREIT did a $500 million equity offering in 2019, which I think was the highest for a REIT in Canada. But you'd call them. You'd work with them on the deal size, the use of proceeds, the disclosure, what the issue discount is. There'll typically be an issue discount relative to the last trading price to be able to, sell such a large volume. And the banks will buy the equity off of you and then resell it to their investor pool, be a mix of institutions, domestic and international, as well as the retail investors. So that'll be sold through the syndicate, typically overnight, maybe a little bit into the morning. Hopefully, you don't have a hung deal where the banks are sitting on a whole bunch of your shares and have to sell that out after. And depending on some nuances, you can close, within kind of 1 to 3 weeks, and you'll have your money in there. We also have at the market programs, which has been a lot more prominent in the US, but is making its way here in Canada. It's something that CAPREIT put in place in 2020, early in 2024. We haven't used it, but it's a much more efficient way of raising equity. There's much lower commissions, and you don't have an issue discount, and you can kind of tap into the market for smaller amounts rather than kind of needing to do a bigger one. So we thought we'd put that in place for, when the situation changes and we're able to raise equity and kind of want to be more efficient about it. But that's been the process. I'll say the last 2 years have been very dry on the equity raising side for REITs. So I think I chose a pretty good time to get out of the REIT investment banking world. But
Right.
but I'll say before that, when rates were low, it was very active, and REITs were able to raise equity, go do acquisitions, and the space was in party mode. But until rates get lower, I think we'll continue to stay where we're
Hangover
at.
mode until then. Yeah. Well,
Yeah, exactly. It's one of the benefits. Like the REIT market in Canada is not as large or developed as in the US. So a lot of the REITs are still what you'd call small cap. So we're very fortunate in being the size that we are. We have enough trading liquidity that we can attract a wide variety of institutional investors, and we have enough float that we can actually buy back our shares. I think every REIT, almost every REIT, I'd say in Canada, is trading at prices that make it attractive to buy back their shares. But I think a lot of them are kind of handcuffed by the fact that their float's already too small, and to kind of take it backwards would, cause a little bit of headaches in other ways.
sure. Yeah, that makes sense. So, until you're trading above your NAV and it makes sense to sell new equity, you have other opportunities to generate liquidity and then, to buy things. Speaking of then buying things, what do you think are the opportunities ahead? Looking into 2025 and 2026, as maybe the rate cycle has peaked, maybe not. We'll see what happens as time goes on. Maybe that's actually in Canada. Maybe it has peaked. Maybe you can speak to that. In the US, I think it's a little bit more suspect as to what's going to happen. But where do you see kind of the market going forward? Apartments and then macro, to the extent that you want to, take a crystal ball view here.
Yeah, and so at the time of this recording, our overnight rates 3.25. It depends on the economist you follow, but a lot are expecting rates to be either the overnight rate to fall to either 2 or the low 2s range. So that'll be helpful. That said, we do fund all our debt financing is off long-term bonds. So the Government of Canada bond yields are really more where we do focus. But nonetheless, rates coming down will probably move money out of kind of money market funds and back into the space, and that'll be welcome after what's been a pretty dry period. I'll say Canada had exceptional population growth over the last couple of years. It was, over 1 million folks coming in, which I think for Americans that probably doesn't sound like a large number, but the USA is probably roughly 10 times larger than us. So when you put that in context of how large Canada was, it was exceptional. We have the government's announced that they're going to be trying to reduce the amount of non-permanent residents, so temporary foreign workers and students and some other smaller categories that are in the country. So they're going to try and reduce that because the population growth that happened really did help spur the housing crisis that we're in now. So the expectation is that the breakneck speed of population growth that happened the last couple of years is not going to continue, and in fact we might have some pretty low population growth for 2 years. TBD how well the government can actually execute on removing people after their permits expire. I think you in the U.S. can probably attest to it doesn't always happen as smoothly as one might anticipate, but so we're going to be a little bit lower of a population growth environment, but again, like I said, with the rent control environment, we'll still expect to see positive rent growth because of the delta between in place and market rents. We'll see rates going lower, which hopefully should bring a little bit more capital into the space. And on our end, we have pretty good liquidity. We've shored up the balance sheet from those transactions. We're going to continue to be opportunistic between our share buyback and acquisitions. We underwrite, I'd say, over 300 transactions or potential transactions a year. I think we surpassed 365 in 2024. So I guess we can say that was we underwrote a deal a day. But we'll continue to be opportunistic for those, and we're in an incredibly strong position. So we'll continue to look to improve the balance sheet.
Mm-hmm. Yeah. So relatively constructive, cautiously optimistic. Would be a big characterization there. So that's great. Yeah, especially I think that's a little bit better than we have here in the U.S. Of a view, I think, on the consensus. But from the backdrop of what you said in Canada, you got prospect of lower rates and more liquidity, and you've obviously increased your quality, and then you have the opportunity to again, you can buy your own stock if those discounts stay wide as rates go down. If the discount doesn't close, then you're buying effectively even better and better as rates keep moving down. So that's great.
We're also going. I'll also mention we're going into an election year as well. The current government's been in power. Yeah. I think most Canadians would say so. At least if you look at the polling, we've had the current Liberal, which I'd say is more left-wing government that's been in power since 2015. The polls are indicating a landslide victory for the Conservative government. So, we'd expect to see a pretty meaningful change in government by at some point in 2025. So that'll also add some change to the dynamic, but it's fully anticipated and expected.
Sure, and that's generally constructive for the real estate relatively regulated industry.
I'd say so.
So you operate as a CIO. Could you maybe take a minute or two to just describe kind of what your kind of day-to-day role looks like, and then just kind of what your team looks like, how you operate this relatively behemoth book of business, buying things, selling things, dealing with the investor community, et cetera. Just walk us through what your life looks like a little bit.
Yeah. So I'm really blessed. I've got an amazing team. It's a very high performance team, and everyone's very very engaged and happy to be working on the strategy together. So, given the amount of transactions, it's been pretty dynamic and almost drinking from a fire hose type of thing. for the last year. I mean, we did over 24 transactions, and so that's what we did. But there's also, as I spoke earlier, we cast a pretty wide net and actually worked on quite a few more than that. So I'm really lucky that I've got a large team that's very, very competent and experienced, and I can lean on them. But a lot of what I'm doing is working on the dispositions, which can be very long and complicated and unreliable, and a lot of it's problem solving. And so we cast that wide net, and there's constantly issues coming up, and so working through that with the team on the dispositions and frankly acquisitions is something I find myself as spending a lot of time on. Sourcing deals, again, it's a fairly illiquid market, so meeting with a lot of the private buyers, meeting with a lot of the developers, staying close to them, because sometimes they're not ready to sell, but if you stay close to them and make relationships when they are ready to sell, you want to position yourself to be the right buyer for them to work with. And frankly, that helps us a lot of times, and sometimes helps us get properties for when we're not necessarily the top bidder, but when the sellers cherish the reliability of dealing with us. I also oversee the investor relations functions, and I typically meet with do over 100 investor meetings a year. So as a public REIT, we have hundreds and hundreds of investors, so that's an important part of the job as well. So I'd say almost weekly meeting with investors, telling the story, giving them updates on the market. And then working with my strategic finance team for some of the higher level strategy stuff, and as well with our development team, which I'll say has been less active now that the development market's been a bit tougher. But they continue to work through entitling and rezoning a lot of our excess land, of which the portfolio has quite a bit, so that we're positioned to capitalize on it in a better market. I'd say that's a bit of a summary of what I do if I wanted to oversimplify it.
Yeah, no, sounds like a long day. Plus you got those,
sometimes it can be, yeah.
Yeah, 2 young kids at home too, so got a lot on your hands, right? So I guess we're kind of getting to the end of our time here, so maybe you could speak to looking back at your careers thus far, the successes that you've had, maybe some of the learnings that you've had. Could you think of one or two of your biggest learnings from your time, either in your investment banking side or when you've been at CAPREIT, that might be helpful for people who are either also deal professionals or sponsors, or potentially looking to get into the industry, either on the public or the private side?
Yeah. I mean, one of the things that someone told me earlier on in my career, and it really stuck with me, and I think kind of actually helped guide some of the shifts in my career, but make sure you're doing something that you really love and you're passionate about. You spend the majority of your time working. You should be doing something you love, and when you do that, you'll be more energetic, more passionate, and you'll be exceptional at it. If you're doing something that you don't like, it's going to be a clocking in and clocking out. You won't rise, you won't rise as much through your career progression, and it makes life a lot less fun. So I had my eye on what I wanted to do long term, and I made the career moves and steps to get there. And I work very long hours. I work weekends. For the first couple of years at CAPREIT, I hadn't really taken a week off. But I have fun doing what I'm doing, and I think my team does, and that's why we're able to achieve the results that we're doing. Because while it is a job and we take it very seriously, we have a lot of fun while we're doing it, and that's advice I received, and really struck with me.
Yeah, do you think you're working more or less than when you were in investment banking?
To be honest, it's surprising, because investment banking I did work pretty long hours, but a lot of folks asked if I was moving to a REIT to get more work-life balance.
Mm-hmm.
I'll say the opposite is true. I don't think I've ever worked more than I have here at CAPREIT, but I actually view that as a positive thing. I'm able to achieve what we want to achieve, and learning a lot, working with a lot of, again, colleagues, but slash friends, and having a great time.
Yeah, you're a little bit more of a master of your own destiny versus kind of, working on deals, picking them up, putting them down. A little bit of a difference, dynamic so far as the flow of work, probably between what you were doing before versus what you're doing now.
Absolutely.
So speaking of that, I know you just said you worked a lot of hours and you're working a lot, and so maybe you don't have a lot of time for hobbies or downtime. But if you were to find yourself with a little bit of extra time, any interesting hobbies or things that you like to spend your downtime with, other than spending time with your family, of course?
Yeah. So I used to be pretty active doing Brazilian Jiu-Jitsu. So that was something that was really fun for me. Since, with the busy schedule, it's really, really hard to kind of keep that up. But that was that for me was a great way to stay in shape, to clear my mind. It was something I really enjoyed doing.
Yeah, very good.
I tried getting my daughter into it. She did it for a few months, but it didn't really click with her. But
yeah. Those kids, they pick things up fast, they drop them fast. Yeah. Well, Julian, I appreciate the time. This has been really fun for me. You shared some great insights and knowledge within the real estate space. If listeners wanted to get in touch with you or find out more about CAPREIT, what would be the best way to do that?
Yeah, I'm on LinkedIn, so Julian Schonfeldt, and I check my messages fairly frequently, so feel free to drop me a message there.
Excellent. All right. Well, thank you, Julian. And thank you, listeners, for tuning into this episode of Deal Flow. Don't forget to give the podcast a follow on Apple Music and Spotify, and subscribe on YouTube so you don't miss an episode. And if you feel like someone else would get something out of this show, please go ahead and send it across. Feel free to comment below regards to future guests you'd like to see, or get in touch should you think your knowledge and expertise would make for a great episode. Thanks again from me, and we'll see you next time on Deal Flow. Thank you for listening to Deal Flow with me, Michael Poulio. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.